What's up, everybody? It's PJ here with the CRNA drip, and I have some news. If you are a W-2 employee, the tax code is not your friend. I'm sorry, it's just not your friend. It was written for small business owners. It was written for entrepreneurs. It was written for investors. It was written for people who were looking to bring back money into the economy. So when you are a W-2 employee, the government is saying, oh, so you want to just go to work and take home your paycheck comfortably, huh? Well, I'm getting something out of the deal, and that something is going to be taxes, and it's going to be a lot of them. But the government also says, well, if you're a small business owner, if you are a 1099 employee or contractor, and you are trying to pump money back into our economy, I'll give you some breaks. I'll actually give you a lot of tax breaks. Now, 1099 CRNAs, we have a very unique perspective in this because we don't have the same overhead costs as a small business who have brick and mortars or other business expenses, and it can be very tax advantageous for us to pursue our jobs as a 1099 employee, and that's what we're going to talk about today. Now, let me say before we start that I am not a CPA, I am not a financial advisor, and you should always seek financial counsel from your tax professional. This is just my experiences that I have learned thus far and what I have learned about being a 1099 CRNA. And you're going to come across plenty of people who have different perspectives and positions on how conservative or liberal you should be when it comes to tax strategies. So let's get into it. So let's talk about the pros first of being a W-2 employee. I think one of the biggest pros is that it's very convenient for you as the worker. It's very hands-off. All you do is you go to work, you go home, you get paid, and that's it. It's very simple. Your taxes are already taken care of for you. They're just ripped right out of your check every 2 weeks. Your health insurance is taken care of for you and your family if need be. And this is really beneficial because if you do have health concerns that would make it challenging for you to get insurance on your own through the marketplace, getting your insurance through your employer is a great way to go. You get the benefits package, you get your retirement accounts, and you get a percentage that is matched for most employees. You get money for your CEUs every year. Your malpractice insurance is covered, and it's very, very hands-off for you as the worker. You just do what you need to do when you go to work, and that's it. Another benefit of being a W-2 employee is that it is looked to as stable income. Meaning when it comes time to purchase a home or purchase a car and they see that you have a W-2 income, it is looked to as stable, and it makes it a little bit easier to obtain some of those assets. Now let's talk about some of the cons of being a W-2 employee. And one of the biggest cons is the limited schedule freedom opposed to when you are a 1099 worker. So you are always going to be at the discretion of the facility's policy for scheduling time off. And we all know how that goes, where you get a certain amount of time off, you request this weekend off because you want to go to Disney World or you want to go on this great trip overseas, and you get denied your PTO. And if anybody else knows, the alternative meaning for PTO is prepare the others. Another con is you don't have as much control over the type of retirement accounts that you have. Whatever your employer uses for that brokerage or that company that they use for your retirement accounts, that's kind of what you're bound to from their perspective, and then they match into that. Another con can be the fact that that group insurance is provided through one type of provider, so it may not match what your needs are for health insurance or what your family needs are for health insurance. So you may have to get supplemental insurance anyway. So even though that is a pro that it is provided to you, it can also be a con in a sense where if it doesn't fit what you need, then it's almost useless to you. Now, although the W-2 lifestyle is very hands-off for you, it is very hands-on for the government in your pockets when they go to take out those taxes every 2 weeks. And that is definitely one of the biggest cons, and the reason why we're here talking about this with W-2 income. Especially if you are single with no kids, you're out of it. Like, it is just not gonna work out well for you. And you guys see your checks every 2 weeks. I don't need to tell you that. I'm pretty sure you're aware of it. There's also very little that you can do to maximize your tax savings as a W-2 employee versus a 1099 employee. And that is one of the biggest cons and drawbacks of W-2 employment. So next, let's talk about some of the deductions that you can use as a W-2 employee to try to offset some of your tax liability, which again, these are pretty much the biggest 5 that I have seen. And starting out, the standard or itemized deduction is probably one of the biggest deductions that you can get as a W-2 employee. With the standard deduction, it pretty much is determined by the type of filer that you are, whether you are single, head of household, or if you're married filing jointly. That will determine how much you get as a standard deduction. So I believe as of 2024, the standard deduction for a single individual is going to be $14,600. If you are head of household, you're looking at about $21,900, and if you are married filing jointly, I believe it is $29,200 that you can get as a deduction from your taxable income at the end of the year. Now, on the opposite end of standard deduction, you can do an itemized deduction where you can take expenses that are pretty much in limited categories, and if that number for those expenses exceed the amount for the standard deductions according to the type of filer you are, then you can claim those itemized deductions. So these expenses can be things like your mortgage interest rate, your property taxes, medical expenses, dental expenses, and charitable contributions to a qualified 501c3 organization. Now, this is how I think about it. There is only so much mortgage interest, medical expenses, property taxes, and charitable contributions that you can make to where it becomes more of a disadvantage for your pockets than a tax saving strategy. You know, nobody is purposefully going to the doctor to rack up medical expenses to get the itemized deductions. You know, nobody is hoping that they accrue so much mortgage interest so that they can get the itemized deduction for it. That's just not feasible or not realistic to me. Now, of course, as a W-2 employee, you are going to get retirement accounts like your 401k, and you make contributions to that, and it will also get matched by your employer to a certain percentage. But the contributions that you make into your 401k can be tax deductible up into a certain amount. And I believe for 2024, at the time of this video, you can max out your 401k at $23,000, and if you're under 50, and if you're over 50, you can max it out at $30,500. In addition to that, if you have like a traditional IRA, you can max that out at about $7,000 for the year, or $7,500 if you're over 50. Now, the last W-2 deduction that I really want to talk about is the child tax credit, which if you have children, which a lot of people do, and you claim them as a dependent because they qualify as a dependent, then you can get up to a $2,000 tax credit per child. And I say up to because there are some stipulations to that. If you make over $200,000 for the year, then you do not qualify to get the $2,000 tax credit for the child. Now, if you make over $200,000, you may be able to get partial credit, is what I read on the IRS website. And if you make over $400,000 a year filing jointly, then you do not qualify for the $2,000 for the tax credit for your child. Now, I don't know about you, but I don't know many CRNAs or anybody that are just having kids just to get $2,000 for a tax credit on taxes. And as a CRNA, our incomes typically fall between 32 to the 35% tax bracket. And I don't know many CRNAs that are making less than $200,000 for the year single, unless you're like part-time, or unless you're just in a market where 200 is kind of pushing it. But again, that's very rare anywhere in the country where you're not making at least $200,000. But this is why when I talk to a lot of senior SRNAs and they're really excited about their job searches, they're really excited about finding a job where the pay is really good and it's W-2, I try to emphasize to them like, hey, the more money that you make, the more the government is gonna take. So that kind of puts it in a different perspective for them to think about, is this really the best decision for me? Now, next, let's start with the cons of being a 1099 employee. So everything that I mentioned that was a pro for W-2 employment is gone away. It's taken away, And now the convenience is completely gone and you have to do everything on your own. So from this point on, you're responsible for paying your own quarterly taxes. You're responsible for getting your own health insurance. You're responsible for covering your own malpractice insurance in most cases. Your retirement account management is completely in your hands. You lose that match. You lose the benefits package. You have to pay for your own CEUs. You are responsible for doing your own bookkeeping. So these are all of the things that you are now responsible for doing on your own as a 1099 employee or CRNA, and you have to think to yourself, is losing that convenience gonna be worth it? And all of these negatives worth it? But I also want you to start thinking, is it really a con to have to be in control of all of these attributes of your job and of your business? So now you have gone from only focusing on going to work, doing your anesthesia, taking care of patients, going home, getting paid, and going about your day, to now having to manage every aspect of how you get paid, your retirement accounts, and all of your benefits and everything on your own. And you have to think, is it worth it? So let's start with the first point of consideration, which is the retirement accounts. And I think that's one of the biggest considerations that you have to think about when you're thinking about, should you switch from W-2 to 1099 or should you start 1099, is when you have that match from your employer into your retirement account, is losing that match, does it make sense for you? Or is it something where you're thinking, if I lose this match, I'm losing out on a lot of money, and I don't think I'll be able to contribute that money even if I go 1099 and I get paid more. I still won't be able to contribute that amount. Another thing to consider that can be possibly thought of as a negative or a con of 1099 work is that to some lenders, not all, but to some lenders, it is considered unstable income. And this is primarily for locums providers because you do contracts that have different lengths of time. You go periods of time where you're not working. You may be making $50,000 one month and then you don't work the next month, so you don't have any income. And that can look unstable to some lenders, not all, because if you work with the right lenders, they understand how 1099 works, especially for our profession, and it's not as much of a problem. Now, another potential negative or con for being a 1099 employee or 1099 CRNA is there is no PTO necessarily. So when you don't work, you don't get paid. And this is primarily for locums travel CRNAs when you do contracts here and there. Now, if you are a full-time 1099 employee, you may still get time off that you can schedule and still get paid the same salary that is set for that year. So next we want to talk about the pros of being a 1099 CRNA. So probably the most noticeable pro of being a 1099 CRNA is the increase in pay. Generally, you're going to get paid much more as a 1099 CRNA than you will a W-2 CRNA. So when you are negotiating pay, keep in mind that in a lot of cases, the pay will double from what you are making as a W-2 CRNA to a 1099 CRNA. Another pro for becoming a 1099 CRNA, which is probably even more so than the pay, is the schedule freedom. When you are a locums 1099 CRNA, meaning that you are traveling to do different assignments, different lengths of time, you have the ability to build your schedule how you want it. So if you want to build in a 2-week or 3-week vacation during your contract, you can do that. Now, again, you won't be getting paid for the time that you don't work, but you have to go back and forth with, is pay necessarily more important than that freedom of schedule to you, and vice versa. So as a 1099 CRNA who does locums work and travels, you have now intrinsically built in this opportunity to travel around the world more, spend more time with your family and do family vacations, or just be there for moments that matter the most. You also have that time off to develop other business ventures that is going to generate money outside of you being a CRNA, whether that's real estate ventures or other business ideas and passions that you want to develop. Now, if you do choose to be a locums CRNA, many times your travel expenses are paid for alongside that salary that you are getting paid to come work for that facility. You can opt to do full-time 1099 work if that facility allows for it. And the benefit of this is that you don't have to travel as much. So if your family's home base is in one spot, you can still get the tax benefits of being a 1099 CRNA without having to travel as much. Now, from what I've seen, locum travel CRNAs will get paid the most. Next will be your full-time 1099 CRNAs, and then W-2 CRNAs at base. And the biggest pro of them all, the one that I want to spend the most time talking about, is the business deductions. Yes, you get so many tax advantages by becoming a 1099 CRNA. So as a 1099 CRNA, you are considered a business and you are treated as such when it comes to business deductions. According to Section 162A in the tax code, any expense that is deemed ordinary and necessary for you to operate your business can be considered a business expense and then can be considered a deduction from your taxable income. So what does this mean for you as a CRNA? This means that all the expenses that you were going to accumulate throughout the year anyways, that you're already paying for, you can now use those expenses to deduct from how much taxable income you have throughout the year. So let's do a little case study. Let's do a little deductions case study. We're gonna throw in some numbers here so you can get a glimpse of how this benefits you in the long run. Now, keep in mind, these numbers are completely made up and your situation is gonna drastically change based off of your salary, the type of business expenses that you have, and the type of deductions that you are going to take, and what you and your CPA will develop in your plan for your tax strategy. So let's take Dr. Pickle. Y'all remember Dr. Pickle from videos way back. So let's say that Dr. Pickle is a CRNA and he is making $300,000 a year, right? Very modest salary, very realistic for a 1099 CRNA. So let's say Dr. Pickle wants to buy some new scrubs. He wants to buy a new stethoscope. He wants to buy a Butterfly IQ ultrasound probe, portable ultrasound probe. Because he is now 1099 and that's something that he has wanted. And let's say that costs him $5,000 altogether. Now, if Dr. Pickle was still a W-2 CRNA and he decided to purchase those items, that would not be considered a tax deduction. He would still pay for that $5,000 and still be taxed on $300,000. But because Dr. Pickle is now a 1099 CRNA, he is going to spend that $5,000 to purchase all of those items, and that $5,000 is going to come off as a business expense and be deducted from his overall salary. So instead of being responsible for paying taxes on $300,000, he is now responsible for paying taxes on $295,000. Stay with me. So now that health insurance that you lost from your W-2 employment, you now need to find on your own through the marketplace. And the benefit of this is that you can shop around for whatever plan is going to make most sense for you and your family and is going to be most beneficial for you, and you pay for it that way. That premium that you now pay every month becomes a business deduction. So let's say Dr. Pickle has bought a plan, health insurance plan. He loves the plan, and it's going to cost him about $6,000 for the year. Now, we had just said that we went from $300,000 of tax liability to $295,000 of tax liability. Now, with this $6,000 that he has spent for the year, he is now liable to pay taxes on $289,000 for the year. Now, as a 1099 employee, you can utilize either a solo 401k for your retirement vehicle or a SEP IRA for your retirement vehicle. And the benefit of these is that you can maximize so much more in contributions than you can as a W-2 employee with a traditional 401k. So right now, as of 2024, like we said, on the W-2 side, you can maximize about $23,000 if you're under 50 and $30,500 if you're over 50 to your 401k. For a solo 401k or a SEP IRA as of 2024, you can maximize up to $69,000 into your retirement account for the year. So let's say that Dr. Pickle is very, very aggressive with his contributions to his retirement accounts. That is he believes in it wholeheartedly. You need to max it out, max it out, max it out. So he contributes $69,000 into his retirement account. That $69,000 is now a tax deduction from the salary of $289,000 that we had. So now he is now liable to pay taxes on $220,000 for the year. Stay with me. Now let's get jazzy and let's bring in the home office deduction. There are so many ways to utilize the home office deduction for your business, and you are already paying rent or you're already paying a mortgage, and now you can turn that into a working tax deduction for you. So let's talk about it. And one of the ways is the Augusta rule, or the Masters rule, which was coined based off of the Masters tournament that happens in Augusta, Georgia. And basically the Augusta rule says that homeowners are able to rent out their home to their business or to a business for no more than 14 days out of the year, and the amount that that business pays to rent out that home can be a tax deduction. Another method that is used is the simple method, and I don't necessarily recommend this method, but it is doable. And it's very, very overly simplified. It just says that you are allowed to claim a $1,500 deduction for the year for your home office. You're missing out on a lot of money when you do it that way. Now, going back to our example, the way that Dr. Pickle is going to use his home office deduction is called the regular method. He has a dedicated space in his home or his apartment where he strictly does business. It's for his business meetings, it's for his business planning, it's for his mentoring, his coaching, and all of the above. It's strictly for business. He's going to take the square footage of that room or that space, and he's going to divide it by the total square footage of his home or his apartment, and he's going to get a percentage out of that. That percentage is what he's going to use as a deduction from his rent, because that portion is going to be used for business, from his utilities, because that portion is going to be used for business. So we're going to leave the utilities out of it, right? Just to kind of keep the numbers a little bit more clean. Let's say that out of the year, Dr. Pickle uses 10% of his home for business. And that 10% is going to run him about $5,000 for the year. So he can use that $5,000 for the year as a tax deduction, because that's a portion of his rent that is used for business. So now from the $220,000 that he was responsible for paying taxes on, he has now dropped it down to $215,000 of tax liability. Stay with me. Now let's get jazzy and bring the cars into the situation, okay? Because that's huge as well. So let's say Dr. Pickle has two cars, one that he uses strictly for personal use and one that he uses strictly for business use. The car that he uses strictly for business use, he has a couple of options on how he can maximize tax savings. The first way that he can do it is by doing a standard mileage deduction, where he deducts based off of the miles that he uses for business. The second method that he can use is the actual expenses method. And this is accounting for all the expenses that it takes for maintenance, for gas, for different services to keep his car up and running for business. He's going to claim that expense as a business expense, and it will be a tax deduction. Now, if Dr. Pickle only had one vehicle and he used it for business 50% of the time, then he would just take 50% of whatever that total expense would be and apply it as a business deduction. But since he has two separate cars and one that is strictly for business, he's going to claim the $5,000 for the year that totaled up for maintenance and gas and all the above, and he's going to use that as a business deduction. So from that $215,000 that he was liable for paying taxes on, he has now dropped it down to $210,000 of tax liability for the year. Stay with me. Now we're going to take the jazziness a step further, okay? So we're going to say that Dr. Pickle has been wanting to buy a new car for his business since he graduated school 2 years ago, and he has finally gotten to a place where he has all his business documents together. He's able to purchase a car in his business name, and he's ready to go forward and buy a car. When it comes to buying a car in your business name, and that being a sole business expense, as a 1099 CRNA, you can utilize what's called bonus depreciation to maximize your tax savings even more. With bonus depreciation, you used to be able to deduct 100% of that business vehicle's total purchased amount from the current year that you are purchasing that vehicle and placing it in use for business, if the vehicle was over 6,000 pounds. That was in 2022. In 2023, it dwindled down to 80%. So you could deduct 80% of that vehicle's purchased amount and use it as a business deduction for that current year of 2023. As of 2024, it has dwindled down to 60%. We are in 2024. Dr. Pickle says that he wants to buy a car that is going to maximize his tax savings because he was going to buy a car anyway. And he wants to buy a G-Wagon because it is over 6,000 pounds. And that's his dream car. And let's say this G-Wagon is going to run him $100,000 and he's going to finance it. Because the purchasing price was $100,000, he has it in his business name. It is over 6,000 pounds. He is going to place the vehicle for 100% business use because he has his other cars for personal. He's going to place it in use for business in the year 2024 when he purchases it. And he's going to claim 60% bonus depreciation on that vehicle. So now he takes a $60,000 tax deduction against his taxable income for that, just using bonus depreciation when he financed that vehicle. So now we were at, let's see, $210,000 of taxable income. And because Dr. Pickle has now purchased this or financed this $100,000 vehicle, and he is using bonus depreciation as one of his benefits of being a 1099 business owner, he is now liable for paying taxes on $150,000 of taxable income. Stay with me. So side note, so now that I've learned about this and I see celebrities who buy these G-Wagons and these other really big cars that are over 6,000 pounds, and now I think about it like, you needed that as a write-off, didn't you? Yeah, you did. You needed a write-off. That's why you got it. I got it now. I understand now. I see you. Dr. Pickle has now dropped his total tax liability or taxable income from $300,000 at the start of the year. He has now dwindled it down to paying taxes on $150,000 of that amount. So as a 1099 CRNA, you also can use your business trips as a tax deduction. So let's say that Dr. Pickle wants to take a business trip to a regional anesthesia conference for a week down in Florida. It's in Florida somewhere. It's on the beach. It's really nice. It's a week. And now the total amount for the conference, the total amount for his hotel room, for his flights, for his rental cars, and everything, and meals, all of that is going to cost him, let's say, $5,000. So now, because this is an ordinary and necessary expense for him for his continued education of being a solid, strong anesthesia provider, he can use that $5,000 as a deduction to his taxable income. So now we have decreased our taxable income from $150,000 to $145,000. So Dr. Pickle was trying to do all of the managing of his finances by himself. He wanted to do his own bookkeeping, but it started to get to be a lot for him. So he decided to hire a CPA that was not only going to plug in numbers and tell him what he was going to pay at the end of the year, but he wanted to hire a CPA that was going to also operate as a tax strategist. So he wanted a good CPA, and that's what you should look for. A good CPA that is not just going to plug in numbers. They're going to help you strategize how to pay the least taxes possible. That is legal, okay? That is legal. That's what we want to do. And all we're doing, we're following what the government gives us in the tax code and using it to our advantage. So he finds a great CPA. He practices in Ohio, and the CPA that he hired is in New York, right? So this CPA is going to cost him $5,000 for the year, but they're going to do the quarterly taxes. They're going to do the annual tax filings. They're going to do business consultations. They're going to do business meetings monthly. They're doing the bookkeeping. They're doing everything, and they're helping him strategize all of his endeavors so far. So it's going to run him $5,000. That $5,000 is now a tax deduction. So we were just at $145,000 of tax liability, and now with the CPA on board, we have dropped it down to $140,000. Now, keep in mind, these are all things that Dr. Pickle was going to do anyway. He was going to take that business trip. He was going to go to that conference. He was going to buy a new car. He was going to contribute to his retirement accounts. He wanted a CPA. So these are all things that he was going to do anyway. But as a W-2 employee, he would have not been able to claim these deductions on his taxes. But as a 1099 CRNA, he can, and he is saving half of his taxable income already. He went from 300,000 to now, well, more than half. We're down to 140,000. Stay with me. Now, in talking to his CPA, Dr. Pickle was advised to consider electing his business, his LLC, to be taxed as an S corporation. And the reason his CPA suggested this was because he was making more than $40,000 as a 1099 CRNA. So he wasn't just moonlighting here and there. He wasn't a W-2 employee and then moonlighting a 1099 assignment here and there and only making, $35,000 for the year. He was a full-blown 1099 employee making $300,000 a year. So he wanted to elect for the S Corp tax status. Now, the benefit of electing as an S corporation for your tax status is that you are able to hire employees under your business, which is going to save you on the self-employment tax of 15.3%. And also, you are now responsible for paying that employee, which is going to be himself. So Dr. Pickle's business, Dr. Pickle Anesthesia, is going to hire Dr. Pickle as an employee of that business. And he now has to pay his employee a reasonable salary. So now that Dr. Pickle has elected his business to be taxed as an S corporation, and he has hired an employee himself to work for him, he can now benefit on the business side by paying that reasonable salary to the employee, and that reasonable salary now becomes a tax deduction. Now, I will say that the reasonable salary debate is something that you're going to subjectively see in all types of forums and comments, and everybody has their opinion based off of what their CPAs are telling them and discussing and strategizing for what should be considered a reasonable salary for a 1099 CRNA. And I've seen people who argue that, your reasonable salary should be based off of the current market of what CRNAs make and what would be considered reasonable. And then you have some people who think more of a business standpoint and say, well, your reasonable salary is whatever your business makes minus all of your business expenses for the year, and whatever you have left, you pay as a reasonable salary to your employee. And that's how you deem your reasonable salary. You may also hear a specific percentage that should be looked at as a reasonable salary. I've seen a lot of numbers floating around. The most common one I've seen is like 30% of whatever the business makes should be a reasonable salary. But again, these numbers are only going to be set in stone when you have your actual tax plan developed with your CPA/tax strategist, and they come up with the numbers for what makes the most sense for you and your situation. From my standpoint, finding a reasonable salary is a balancing act between trying to get the best and maximize the best deduction possible on the business side without overshooting the salary, because then you have a high number on the personal side that you have to pay taxes on. So you really want to try to find that balance between what's going to give me the best deduction on the business side, what's going to make me pay the least on taxes on the personal side. And I also think that your reasonable salary should be based off of the lowest amount needed to take care of all the expenses that cannot be deemed as a business expense. So let's say Dr. Pickle and his CPA have a meeting and they come up that his reasonable salary number needs to be $80,000 for the year. So with that current business income of $140,000 that we have dwindled it down because of business expenses, we deemed $80,000 as a reasonable salary for Dr. Pickle because he is now an employee of his business. So he now gets an $80,000 deduction from that business salary. So now we go from $140,000 to carry the one, $60,000. So now we are responsible for paying taxes on $60,000 on the business side, and we have $80,000 that Dr. Pickle will now pay taxes on the personal side because he is now a W-2 employee of his business. Stay with me. Now let's just say we stopped the deductions here, because there's so many other deductions. There's so many other basic and advanced tax strategies that will legally help you to mitigate your tax liability as much as possible. I'm just not equipped enough to explain that, which is why I say always talk with your tax professional. This is not tax advice. This is just an example. So we stopped here. We didn't talk about the phone that we're going to deduct for business expenses. We didn't talk about business subscriptions that we pay for. We didn't talk about real estate, which really ups the ante. So we didn't even get into those things. We're just going to stop right there. Okay. Now, because the government loves us small businesses so much, they're going to give us what's called a QBI deduction, or a qualified business income deduction, just for fun, just because we're a small business. And basically that QBI deduction is an additional 20% that is taken off of your taxable income on the business side. So we had $60,000 that was left of taxable income on the business side. We get a QBI deduction of 20% of that, which is $12,000. So now we're left with, carry the one, $48,000 of taxable income on the business side, which is still pretty high of a taxable income for a business when we are not even including a lot more tax deductions that we can implement. So we started out with a $300,000 salary. Well, Dr. Pickle did, not me, Dr. Pickle. $300,000 salary, and he's ending up to pay taxes on $48,000 on the business side. And remember, because he elected to do S corporation for tax purposes and hired himself as a W-2 employee and paid himself a reasonable salary of $80,000 for the year, he now has to factor in all of those deductions that we talked about that were pros for the W-2 standpoint and apply that to his W-2 income. So let's just say he decides to take his standard deduction. He's single, he doesn't have any kids. He's just gonna take his standard deduction. So now we still have $48,000 of tax liability on the business side. But on the personal side, we have now dropped our tax liability to $65,400 that he has conveniently paid taxes for throughout the year, because that W-2 income has the taxes taken out right away when he gets paid. And again, we left out so many other business deductions that it could have dropped that $48,000 down even more. But we're going to leave it right there for the example. And that's what I want to reemphasize, the importance of having a good CPA who knows tax strategies. You don't want a CPA that's just going to be lazy, that's just going to plug in the numbers that you give them and say, here's your tax bill, this is what you pay, I'm done. You don't want that. You want somebody that's gonna help you mitigate your tax liability legally. So ultimately, your decision to go the route of W-2 versus 1099 is gonna be determined by your needs, your family situation, and your financial priorities. But I know that I am extremely, extremely glad that I started my career as a 1099 CRNA. But I want to know from you guys, what would you prefer? Would you prefer the convenience of being a W-2 employee? Or would you prefer the added tax benefits of being a 1099 employee? Now, as you're dropping those comments in, make sure that you subscribe, make sure that you turn on your notifications so you know when I post. And with that being said, I'm out.